Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking lithium, the key component of the lithium-ion battery, so crucial to energy transition and in particular electric vehicles. The demand for lithium is expected to outstrip supply by double in 2040, even with the most optimistic projections around production. How is lithium produced? How is it transformed into the cathode that goes into the batteries? And what's its market structure? Joining us to discuss is Simon Moores. Simon is the CEO of Benchmark Minerals, which provides pricing, data and analysis to all of the participants in the supply chain around batteries and provides the key benchmark price for lithium. Simon's also appeared before Congress, as well as advised various governmental bodies around the world. Simon, thanks for joining.
Thanks for having us, Paul.
So we're talking lithium. Before we sort of dig more further into the chemistry and the industry itself, can you just give us a quick headline overview of lithium itself and what the trends have been around its consumption and pricing in the last 5-10 years or so?
Yeah, sure. So lithium is the key component that goes into an electric vehicle. In terms of volume used, it's number one. Actually, it's the number two, and graphite's the number one, but that's the anode. We can talk about that later. But lithium is also the proxy, raw material, chemical, commodity, whatever you want to call it, even though we don't call it a commodity. And the key thing here is every electric car now, every electric car in the short and the medium term, and in our belief, the long-term future will be lithium-based battery technology, and that's why it's so important.
So you've mentioned it there, lithium is the key component of the lithium battery. Can you just give us the overview of exactly how lithium is used, what's it used for, and how it links to batteries?
Yeah, so where we stand today is over 50% of lithium that comes out of the ground ends up in a battery. And of course, the vast majority of batteries end up in an electric vehicle. So lithium is driven by EVs and EV batteries. But of course, lithium's roots weren't in lithium-ion batteries originally. They were in industrial markets like ceramics and grease, like industrial greases. And really the last 5 years has been a complete switch, really, from being driven by industrial markets to actually now being driven by this high-tech EV battery market.
Yeah, and just a bit of terminology there. So we're really talking about the lithium-ion battery. As I understand, you've got the lithium cell batteries, the Duracells or whatever, that contain lithium, but it's the lithium-ion battery, which is the rechargeable battery, which we use in our phones, which we use in EVs, that is really the driver of that consumption. I guess two questions. Firstly, can you give us some idea about the demand on the battery side? And also, there's a lot of talk about the evolution of batteries, the development of batteries, and is there anything on the horizon out there that doesn't really include lithium that might disrupt this entire conversation?
Yeah, so firstly on the demand for the battery side, kind of what's the shape of the story, if you like, and let's talk on a 10-year horizon. So where we are today versus where we are likely to be in 10 years' time. And right now, the lithium demand market, which is way over 80% driven by battery. So it's really a lithium-ion battery EV story. Well, that demand pool over 10 years wants to grow on our average at the moment, and it's getting stronger, 21% CAGR growth rate a year on average over the next decade. That will actually just get stronger. But take that 21% number. Now, the supply and the problem you've got, or the industry is facing, is the supply at the moment is only growing at 11%. It's growing half the pace of the demand. And that, what we call this great raw material disconnect, is just getting wider for a number of reasons, which we can discuss in this podcast. And I think that's first an overarching story that people need to understand. There are other battery technologies that are being developed. I mean, many are known. Some, you're right, some are still being innovated and explored. The key for us here is lithium-ion batteries. There are many flavors of chemistry of lithium-ion batteries, but these are all quite simply nickel, cobalt, everything's lithium, and then you add the nickel, cobalt, manganese, the NCM or the NCA element to it. So this is all lithium-ion batteries. And the reality is that different varying flavors of this lithium-ion battery will be around for decades, not just decades, and I can explain a bit later on, but there are other technologies coming through. Solid-state batteries are one, but that is also lithium-ion batteries. So we include it in that. We call that like a super advanced lithium-ion battery, let's say, and still that's very early stages. Then you have sodium batteries and other different flavors that are being explored. The key thing about here is for transport, at least, which is the big industry that's been disrupted, batteries need to be light and they need to be energy dense. So it needs to be light because you've got to put it in a car and transport it. If they're super heavy, it's going to run down your battery quicker. And as a result, it needs to be energy dense. And lithium as a solid is the lightest element in the periodic table and one of the most energy dense. So in terms of fit for purpose, it's very, very difficult, almost impossible to beat lithium. And as a result, we call this era, like this economy that's being built, is a lithium-ion economy. And I don't think that's going anywhere.
And even at Tesla's Battery Day, I guess in September 2020, their most recent one, they essentially committed to lithium-ion as their battery that they'll be using for the next decade and beyond.
Yeah, exactly. Lithium-ion batteries, there's the three fundamental tailwinds to understand about lithium-ion batteries. And I've been in this industry all my career since 2006. And the key things are they're getting better, they're getting cheaper, and they're becoming abundant. Doesn't mean there's bumps in the road to get to these that is going to slow this pace of growth, but they're getting cheaper because even since anyone's cared about lithium-ion batteries, they've gone from $280 a kilowatt hour average to our automotive average, Benchmark's automotive average price of $110 a kilowatt hour last year for the whole of 2020. So significant drop there. They're getting better because I reckon on average, batteries now are 25% better in terms of energy density, in terms of performance in an EV, in terms of how the software interacts with the batteries in the pack, which is pushing your cars further and further. And then the third thing is the rise, what we call the rise of these battery megafactories or gigafactories. We've gone from 3 of these when Elon Musk and Tesla built the first one in Nevada. And right now in the pipeline, we've got 192. So they're becoming more abundant.
Yeah, we're going to come on to the giga, soon to be terafactories. So let's talk about the lithium supply chain, because I think this is crucial to the commodity aspect and story of lithium. So you've got an upstream, a midstream, and the downstream. And the first thing to say is this is far more complicated than, say, iron ore, right? We're really talking about challenging upstream, a really challenging midstream, the chemical processing and production of the cathode, and then the downstream, the creating of the actual battery cell. I think this is crucial to understanding pricing and everything. Can you start off on the upstream? Can you just give us an overview of what the lithium upstream looks like and the nature of it?
Yeah, sure. So lithium is a specialty chemical. It's not a commodity. Now, commodity, it's kind of a wide sweeping word, and people can put actual commodities in that bracket, which iron ore definitely is a commodity. Stuff like orange juice, and from that movie Trading Places, which I loved growing up, was pork belly was one of them. And these are classic commodities in my eyes. When you have a specialty chemical, number one, you can't use all lithium in batteries. You can't even use all lithium in the steps in the middle of the supply chain, the cathode and the chemicals. The second thing is not every customer can take all the lithium that's available. So it's very much tailored for certain groups of customers. And those are the core things to understand about this lithium being a specialty. Now, for lithium to scale, you have to scale a specialty industry, which is kind of finding a balance, if you like. And as a result, the companies getting into the market, or even the traders or investors, need to understand that there's bottlenecks everywhere. And understanding those bottlenecks is understanding actually how much lithium is available for the end market at the end of the day. And that also translates to lithium prices, which is a wide range of different prices for battery applications, technical applications, even other grades that go into completely different supply chains. So that feeds through to the pricing structure of lithium as well.
Staying on the production side, lithium is abundant in the Earth's crust, but there are 2 main sources that it's actually mined, at least economically, I think, which is the key crucial part here. It is a rock and it is a brine. Can you just give us a bit of an idea about that?
Yeah, I remember writing an article for my first ever publication I worked for, Industrial Minerals it was called at the time. My friends gave me hell for that one, but it was a great industry and business to work in. The article was called Between a Rock and a Salt Lake. That was it. And that sums up lithium up, I think. It's you have these brine sources in South America predominantly, Chile and Argentina. And then you have the hard rock lithium, which is Australia right now. And what we found in the last number of years is brine was, 5 years ago, brine was the number one source. But scaling that, it takes longer, it's a bit more complex, and it just takes that time. And compared to the spodumene hard rock, which traditionally was the more expensive route, in fact, it depends where you measure that cost. But of course, with the hard rock, it's mining in Australia, it was scalable. And as a result as well, China, who buys that raw material to convert into lithium chemicals, had the capacity and also expanded the capacity of the chemical refining aggressively. That's put Australia and China partnership as now the number one source of lithium in the world. And of course, then every region in the world now, Europe, North America, they want to build this part of the supply chain for themselves also.
Yeah. So I think it's crucial to say that just looking at your various presentations and reading it on the subject, of course, is that this is really the rate limiting step in some senses. It takes, using your own numbers, 5 years at a minimum to identify and then scope out and get up and running a hard rock lithium mine. And brine's a completely different matter, right? It takes also a very long time and it has its own economic challenges. But this is where we're starting to build this picture up of you've got car factories being put up, or battery cell factories every 3 years, but lithium production taking a cycle of 7 years or something. This is one of the first bottlenecks in the industry, correct?
Yeah, 100%. It takes, tell me yours, use 7 years to build a lithium mine, 24 months to build a battery plant. That's your disconnect. And of course, there's with loads of investment going into battery plants, but hardly anything going into lithium upstream. There's going to be a crunch point, and we're starting to see that as well with lithium prices going up within China 70% in the last 2 months. You're starting to see this wall of EV demand starting to hit the upstream of the supply chain, and that's because the downstream aren't fully, they don't even fully understand the upstream, or there's too much risk, and they therefore don't want to put their money into it.
So you've got rock or brine, and it's typically Australia, Latin America for the most part, other little pockets here or there. It's the midstream that China dominates. I think almost 80% of the midstream sits in China. That's a combination of chemical processing and production of the cathode. Can you just talk about chemical processing to start off with, and kind of how the Chinese came to dominate that slice?
Yeah, I mean, the origins weren't in processing lithium for batteries, that it was processing hard rock lithium from one mine in China, Greenbushes, for other markets, right? For the other industrial markets I mentioned before. And as a result, that was 20, 25, 30 years ago, when this kind of in the mid 80s to early 90s, where this technology and know-how left, let's say, Western societies and went into China. Of course, China was building its industrial heartland, if you like. China was rising. We're all familiar with that. And lithium was part of that story. So China learned how to expertly process lithium, spodumene is the term, lithium hard rock, for lots of different end markets. And then the key thing is about 10 years ago, China started aggressively, let's say between 5 and 10 years ago, started aggressively expanding this capacity. So A, Chinese companies had the know-how, and B, they were willing to invest to expand the capacity and grow its market position, not only domestically, which was the start with batteries and EVs, but now also internationally, and kind of leaving other companies outside of China behind.
Thanks for that. So what exactly are they chemically processing the lithium into so that it could go into the cathode? And also, as I understand it, this isn't exactly an environmentally friendly process. It's using a hell of a lot of power, and it's also using some pretty nasty chemicals as well, right?
First question, predominantly making lithium carbonate or lithium hydroxide. They're the top two chemicals that really people need to understand and get a grasp of. Both are used in lithium-ion batteries. Lithium carbonate is the traditional material that's used in lithium-ion batteries, and it's used a lot in, so let's call it traditional technologies. And then lithium hydroxide has been the higher-end battery technologies. So if people have heard of lithium-ion batteries using more nickel, this high nickel batteries, well, you need lithium hydroxide for that. And so, but there are two chemicals that are both used in batteries in electric vehicles, and they're both growing at significant rates. But hydroxide is growing quicker because it's also coming from a smaller base. And their feedstock, predominantly spodumene from Australia, is then being processed into these white powder chemicals, then sold onto cathode makers, battery makers, to literally you've got a bag of, think of it in these terms, you've got one bag of lithium carbonate hydroxide. You've also got one bag of NCM or NCA, which is your cathode, your other part of the cathode. And then these two bags are mixed. Crude analogy, but it's true. These two bags are mixed, lithiated, and that then cathode is mixed in a big drum with lots of solvents and pasted on a sheet, which is your cathode that gets rolled with the anode. So literally, they're your proportions of a bag of lithium carbonate or hydroxide plus a bag of NCM, nickel, cobalt, manganese. And that effectively is how these products are used in a battery.
Right, perfect. And we're going to come back to both the upstream and the midstream, because really that's where we're seeing the likes of Tesla looking to go up that chain. And that's where I think there's a lot of opportunity or future opportunity for a variety of investors, even traders. The downstream is the mega factory story, we're putting together these battery cells. And that actually is where, to date, we've seen, I guess, the OEMs and also just this huge flowering of these gigafactories. Can you just talk a little bit about what's going on there? And I know from your own sort of the work you've done with governments, national entities, this is quite an highly competitive space, let's say. And I think a lot of those organizations are ignoring the mid and the upstream. But can you just for a minute talk about the factories themselves and what's going on in that space?
Yeah, as I mentioned before, the term we used was two terms actually. One is this rise of these battery megafactories, and a term that I created back in 2015, and kind of it's gone everywhere now, is this global battery arms race. And that is a race for countries and continents to build enough lithium-ion battery capacity to have dominance in the EV space. And the electric vehicles are 21st century automotive 2.0, whatever you want to call it. It is the future of the car industry, of the auto business. And quite simply, back in 2014, Tesla announced that they wanted to build a lithium-ion battery. They called it a gigafactory, which it was 35 gigawatt hours at the time. But essentially, when they were planning this in 2012, they wanted to take all of the world's battery production and put it under one roof just for them. So because actually the only reason they did this is because Panasonic, their partner, wasn't going to increase their own internal production 4 or 5x just for one small startup called Tesla. So they had to go and do it themselves, and eventually they brought Panasonic along to help them with this vision. But point is, that was the first gigafactory, a plant that was an order of magnitude bigger than its predecessors, and that was number one. And now we're at 192, of which, this is key, 135 are active battery plants making batteries for EVs. And that's crucial because this isn't just let's say, a gold rush of batteries. There is an element of the gold rush, but the majority of them are tangible, real assets making batteries for EVs today. So from 1 to 192, and it continues today.
I guess one thing I just want to sort of interject a note here is that not all batteries are the same, right? There's this sort of tier one, which is the Panasonic, the LG, that are going into CATL, that is going into EVs, all the way down to tier 3. So it's also, batteries themselves aren't a commodity either, right?
Exactly. Yeah, you can't use all batteries in all EVs. As you say, there are tiers of quality. And, if you Google battery tier quality benchmark, you'll get we've created a system to actually rank these producers in terms of tiers. And Western automotive producers, Tesla, VW, and so on, they can only use tier 1 quality lithium-ion batteries. And so that's another bottleneck in the supply chain that people need to understand.
So I think we've got a good idea of the upstream to the downstream and the different segments of the supply chain. So everyone's building these gigafactories across Europe, 190 of them expected, 120 operating. How is lithium now then pricing through that supply chain, and who's got that pricing power? Can you just talk about the market structure for us?
Yeah, so you've got a handful of producers and an increasing number of end users, depending on where you rank the producers, you can have a big three, or you can have a reasonably big five, or you can have a majority of, say, nine. But I think the key here is the number of end users of lithium are increasing quicker than the new producers coming through. And the relationship, who has that power? I mean, for the most part, the pricing power lies upstream because of that mismatch of, well, for two reasons. One, the number of the demand profile of lithium, the number of people wanting to buy it, especially the number of people wanting to buy quality lithium for batteries that they need to use. And then, of course, you've got the rate of expansion of new lithium supply, which has been very slow. And, as I mentioned before, it's half the pace of the demand, the pace of the demand story. And so for the most part, when lithium isn't in oversupply, that pricing power lies with the producers and it lies in long-term contracts. But you have moments where it does switch and you have moments of oversupply, which you've experienced the last 2 years, really. And that means that lithium goes cheap. And that's what we saw the last 2 years. And it's been a great time for people making batteries. It's helped reduce the cost of the batteries, as I mentioned before. As I said, since December, we're going into a rising lithium price environment for the first time in 4.5 years. And I think and actually for the first time ever for the EV space, like the serious EV space. And this is going to be a big challenge for buyers that don't have long-term contracts in place.
Yeah, and good if you own lithium stocks. But when you say pricing sits with the lithium producers, does it sit with are these vertically integrated? Does it sit with the chemical processors? Or is it, the miners themselves? How does that all link together? Because there is very little trading. I know Mitsubishi have done a little bit with a Latin American producer of the rock. Can you just break that down a bit more, dig into that?
Yeah, so there's four main stages of getting lithium out of the ground and into an EV. You've got the traditional mining, which people are, of course, familiar with. You've got the chemical refining or processing, which is the next step. Then you've got the cathode making, and then you make batteries. Now, with lithium, the vast, vast majority of producers are actually integrated. They mine and they refine. And that's predominantly because it's coming from a brine background, if you like. So brine being a liquid, well, you can't ship liquid around the world in big tanks. Therefore, you refine it into the chemicals you need. And on the hard rock side, traditionally it's been Greenbushes mine that shipped spodumene ore into China to get refined. But in the future, that's going to take place in Australia. So the mining and that chemical refining is part of the same companies. And then you've got a split. You've got the cathode guys, which kind of sit in the middle between the battery companies and the automotive OEMs. And the relationship with battery companies and automotives is getting increasingly close. So much so, someone's going to buy someone out at some point in the next 10 years. There's going to be mergers, and at the moment they're doing joint ventures, but I don't think that'll last very long personally. So there's a definite split with this upstream power of the chemical producers and then the batteries and automotive downstream, and they got the cathode guys kind of floating in the middle.
And as I understand it, even in Tesla's latest announcement, like the automotive manufacturers and the battery producers are starting to have their eye on the cathode makers, because that's the next bottleneck. Who are the current cathode makers? Where are they based? And do you see government starting to support cathode production in the West as well?
Yeah, cathode's the missing link, really, for me on this whole supply chain. And the main reason is once you have significant midstream capacity in this supply chain, you don't necessarily have to, if you're the USA, for example, you don't necessarily have to mine all the lithium in the world to have dominance in this space. You've got to really take that midstream, take that high ground, if you like. And cathodes is the key, because cathodes, of course, battery plants are being built anyway. The cathode market makes all of those raw materials usable in a battery. And if you have battery capacity, you must have cathode capacity. And what has China done? It's done exactly that. So even though China, for all battery raw materials, so the key ones, lithium, graphite, cobalt, nickel, manganese, I did an analysis on this basket of key battery raw materials. 23%, only 23% are mined in China. So it's not like China has huge dominance on digging it out of the ground on the natural resources. 23% is mined in China, but 80% of these chemicals are refined in China. So Chinese companies are going out and buying assets, buying mines, doing investments to search for new deposits and so on and so forth. And that's key. And so the biggest cathode companies in the world are based in China. You have Umicore outside of China. You have BASF, which wants to go big into EV cathode, but has been a bit slower than the other makers. But, it's still a China story. And I think there are lessons there for both Europe and the US in terms of building this midstream of the supply chain.
Yeah. And what do the contracts look like? These are all, as I understand it, long-term supply contracts on each link of the chain, and there's very little, which is why benchmark exists, right? There's very little transparent price discovery. There's been some attempts, but no sort of exchange contracts have really been picked up. How is lithium flowing contractually through that supply chain?
It's all contract based. There are no spot trading in the traditional sense, and it depends on whether it's a short-term contract, which could be 1 year, or you have the average long-term contracts like 3 years. And some contracts are being discussed, and this is the same for both lithium and cobalt, for 10 years. And there's a reason for it. Number one, there isn't enough lithium to go around anyway for the medium term. Then also, if a lithium company going to invest in a new mine and put $1 billion in the ground for significant new mining and refining capacity, then you want to be pretty sure that what price or roughly what price you're going to get at some point in the future. And you want to know that that company will be around and that can take that annual contracted tons, and they will do so for a fixed, 2 years, 3 years, 4 years. And actually that is the favored route for lithium. That's the route they've taken to grow the market. And really that's the same for cobalt as well, actually. And with cobalt, a good example to show how lithium and the lithium industry and cobalt industry are moving is what Glencore have done with cobalt. They've flipped their business 180 over the last sort of 12 to 18 months, from selling cobalt to a market in short term. When it's ready, sell it, see what you can get. When it's ready, sell it, to actually doing long-term and super long-term contracts. And they've announced them. You can Google it. They've done, as I mentioned, 5-year contracts and a 10-year contract as well. One was with GEM in China. And so the key, this move to building long-term contracts needs a price reference and a price benchmark. And whether that's written into the contract, whether it's used to negotiate the contract, whether it's used for the banks in their models to lend the money. And that's why we set up Benchmark specifically for this reason. And that's why the industry loves what we do and embraces our numbers. And it's been really cool to watch from we're right in the middle of this storm, and it doesn't seem to be slowing down.
Yeah. So that sets us up nicely to say, I think we've got a fantastic picture of the lithium market and what's going on. Let's come back to this challenge. So you've got a expectations demand far exceeding supply. So it makes sense to have these lock up long-term supply contracts now at prices now compared to what's going to go on in the future. And you've got this really difficult setup where a couple of things normally solve for this type of issue. One is you've got lots of investment coming in, but that's challenging because traditional miners, chemical companies would look at the cash flow forecast as a way to make their investment decisions, but lithium's gone through this boom bust cycle that you've mentioned, so it doesn't look great from that standpoint. But you've also got the challenge of there's no real optionality in the supply chain either that is going to allow people to solve, make it the markets more efficient as well. I mean, there's real challenges coming up. How is the world going to bridge this huge gap? And what role do you see fundamentally, when I'm thinking about our audience, what role do you see the commodity trading talent organizations having in that?
Yeah, so lithium at the moment it's this end of this year will be about a 400,000 ton a year industry. In the next 10 years, it's going to at least over 1 million tons, probably to around 1.5. So it's tripling, quadrupling, and so on in a very short space of time. And as a result, not now because it's still a very small industry, but 3+ years time, the industry will need other mechanisms to help it grow, and other mechanisms to access capital and so on. And that does include traders coming into the business. and help actually make markets and, let's say, oil the wheels of the supply chain to, because at the moment it's super rigid. And that's the reason prices snap. When lithium prices go up, they don't go up by 5 or 10%. They go up by 4 or 5 times. As I mentioned, the carbonate price, lithium carbonate, benchmarks lithium carbonate price in China in the last 2 months has gone up 70%. And it will continue, right? Because they're inflexible, rigid supply chains. So absolutely needs traders and other market makers to help oil those wheels. And I think the big part is to actually be the connector between the automotive companies who are brand new to this and the chemical guys, because they're speaking different languages. And there's a role certainly to connect these automakers who are making the biggest contracts, and the chemical companies and the cathode companies. And I think that's where this market is going to evolve. But, I still think we're probably 3 years away from anything like that sort of happening and getting traction. But, it will be a part of the industry going forward.
Especially, I think, because the commodity industry is the one that's also used to these types of cycles and bridging them with financing, a different approach than perhaps your traditional miners. Are you seeing any of those inroads right now? What are you seeing in terms of interest from the commodity trading community, beyond obviously putting money on indexes and stocks to do with lithium off the back of this podcast? But what are we seeing right today?
I mean, the big trading houses we've been, funny actually, in 2015 came to us, research, bought some subscriptions, went away. 2018, same kind of process, went away. 2021, it's happening again. And it's very clear like what the big trading houses are looking for, that they want the things that lithium lack at the moment are enough sellers and buyers, and also scale is key. You say to the big trading house, it's a 400,000 ton market, you'll probably say, you mean 4 million tons, right? No, 400,000 tons. So you can see it doesn't even tip the dial if these guys are involved at the moment. And scale is a big issue also for oil and gas companies getting into the space, because that will happen. Oil companies will get into lithium. At the moment, it's tiny. The growth rates are huge. But, if you're looking for scale, check back in the late 20s and see what happens.
Yeah, and in the late 20s, this is when we're talking around that million tons going up to 6 million tons. As you say, 23% growth rates has a dramatic impact.
Yeah, you have that big step up, actually. The next accelerator. This year is one of our accelerators. The next accelerator is 2026. And that's where you have the next big step up. So, that's the year. Which means if it steps up in 26, then people will probably start taking interest in 2027 and 2028.
Where are you seeing interest in the supply chain? Is it at that cathode point? Is it at the raw material point? Because I guess either side of that, turning it into a specialty chemical. Which one is more prominent when you're talking to the trading community?
When talking to the trading community, of course, mining, commodities, this is the bread and butter. This is the language that the trading community we speak to, and Paul, I guess your audience speaks to. That commodities, that is their language, the upstream. The downstream doesn't tick. Batteries don't really even tick the dial. It's how many electric vehicles will be on, what's the penetration rate of EVs, so we can map it to what's coming out of the ground. There isn't even really a consideration for those bottlenecks in the supply chain, which is where a trader or an investor in this market will get the edge. So from a trading standpoint, it's all about the mine level for lithium, the mine level for nickel, cobalt, graphite, manganese. And actually, for me, my background, where we're coming from at Benchmark, it's all about the chemical capacity, the tier 1 lithium chemical capacity. How much actually can you get through that supply chain? There's a great quote from, I was speaking with Robert Friedland, so I guess your audience will probably know Robert Friedland.
Yes.
It is having a chat with him. Great quote he said, which annoyed me because I want this quote to be mine. But he says, this is the equivalent of taking the contents of the Hoover Dam and putting it through a garden hose. And I thought, yeah, that kind of sums it up.
Do you see, whilst it might be very natural for them to act around the mining side, is the cathode itself, is that an opportunity? Is the cathode the point of differentiation between tier 1 and tier 3, or could that, essentially what I'm asking is, could that become a commodity trading role too?
It could be, but cathodes and batteries are the product of the raw materials. So they live and die on A, the volume of the raw materials coming out of the ground, and B, the quality. So for me, they won't be the differentiating factor, even though there are tiers of quality. I think it all comes back to what comes out of the ground in economic quantities and in EV quality material. And that I don't think will change. It certainly, it won't change for the next 10 years, and then we'll see what happens. But there's fundamentals there at play which are really just anchored into the ground.
So I think that sets us up. There's lots of challenges there, and potentially lots of opportunity as well. It sounds like ultimately at the moment it's one of scale. Is this a market though, even if the scale necessarily isn't there, that everyone needs to keep an eye on if you're involved in the supply side of the other raw materials, cobalt, for example, because you could very quickly find yourself locked out of any of this supply and in a real difficulties if you're in any part of that supply chain with this coming demand.
Yeah, if you're using the market and you haven't got your long-term contracts in place, you will be locked out of the majority of the party. It's as simple as that. And a great example with cobalt hydroxide, future volumes, 85% of the foreseeable future volumes of cobalt hydroxide coming out of the ground, not the existing base, but the future expansions, 85% is already taken in contracts. And so, if you're an automotive OEM now and you might have your batteries, but make sure you've got the key raw materials. And the big worries are lithium and nickel. They aren't cobalt necessarily, but that's, I'd say, a big part of the problem.
Just touching on cobalt there, I know cobalt has a lot of issues around provenance, etc. Tesla have made some noises about trying to remove it as a feedstock to their cathodes. What's your take on cobalt's rise alongside lithium?
Yeah, so the trend in the industry has been to reduce the amount of cobalt in a battery. Now, that's a natural trend that was going to happen anyway, right? So you're going from cathodes, this is an NCM cathode, with the ratios of 1:1:1. And that means N is nickel, 33%, or the ratio of 1. 33% of the battery cathode's nickel. 33% is the M, the manganese. 33% is the C, the cobalt. That was 5 years ago. They weren't going into necessarily EVs. It was in the laptops and other sort of technology markets. But that's the starting point. So if your starting point is a third of your battery is cobalt, you're naturally going to be reducing that because you don't need that much cobalt in for an EV. Now, of course, the holy grail is some companies want to eliminate cobalt, but actually, I think that's more about headlines than it is about realities. The reality is the function of adding cobalt to a battery. It's the great stabilizer. It stabilizes the battery cell. It ensures that thermal runaway doesn't take place, or at least limits that. You need cobalt to make your batteries safe. Now, the question is, how much cobalt do you need, and how much can you get away with? And of course, when you reduce cobalt, you increase nickel. So the other trend on this is increasing nickel increases your battery capacity. So having more cobalt in there is actually a reducing functional factor on your capacity. All in, the reality is the trend is down on cobalt intensity, but because the market is growing so significantly, cobalt demand is growing also with that. With Tesla, finally, as a good example, Tesla will always load cobalt anyway, because I've used this example of an NCM cathode. The other cathode is an NCA, the Panasonic technology. Now, that actually uses much less than 10% cobalt anyway, which is kind of where the other battery guys want to get to. So Tesla started with hardly any cobalt, and they've managed to reduce that as well. It's a great headline for them, but the takeaway message is cobalt is needed for safety. It isn't, in our eyes, going anywhere. And the third thing is you need the DRC to get this cobalt out of the ground. So there are a lot of challenges there, but that's why it's an industry that the automotive companies are terrified about, but it's one that's going to be needed.
So to wrap up, I think it's been a really powerful oversight. You're, as Benchmark Minerals, talking to all of the participants in the space, daily basis, not just providing prices, but also doing a lot of advisory work. Just taking it in order, what would your advice be, firstly, to the OEMs right now as it pertains to lithium?
Yeah. OEMs lock up the lithium in a contract, a long-term contract, put whatever you want in there, but get something in writing. And I would lock it up over a 10-year period personally. Number two is, I mean, this is what the OEMs are doing anyway, but you need independent reference pricing to help reduce that volatility. That's what Benchmark provides, and it's been a great. The story of Benchmark's been a really great story over the last 7 years, and we continue. But the key is lock it up in a contract. Make sure you don't go to the market 12 months out from needing your material. Make sure you do it 3 years out, 4 years out. And that way you can at least have some foresight and some knowledge on when these bottlenecks are going to come, because they will arrive. And volatility is here to stay for the next decade in this market as it grows out.
Yeah. And what about, I guess, government?
Yeah, governments, you have to build. If governments are going to either build or not lose their automotive industry over the next generation, you have to build a lithium-ion economy in your country, on your continent. And what I mean by that is it's not just building massive scale of lithium-ion battery capacity, but the cathodes and anodes that feed into that, plus the precursor chemicals that go into the cathodes and anodes. It's controlling that midstream of the supply. Build the capacity, and the raw material will flow and join up and link the supply chain. And also battery recycling is a third one. Make sure the loop is closed and you have that knowledge there as well. But the key is governments need to build a lithium-ion economy, because lithium-ion batteries, they are the platform technology for this energy storage revolution. It sounds grandiose, but it is that important. And governments are now recognizing that. And as a result, you saw the White House 2 weeks ago put lithium-ion batteries on the top of their supply chain agenda. So movement is starting. The European Union are putting billions of dollars into it as well. But it's not going to be enough. It's just a start.
Yeah. We haven't touched on recycling. It seems like that's sort of a little ways off. And so, well, can you talk to recycling a little bit?
Yeah, recycling, massive capacity of battery recycling is going to be needed, but not now. It's going to be needed in about 5 years' time onwards. And then it's going to have to rapidly scale. So if you think about all these gigafactories being built around the world, you probably need the equivalent amount, maybe less, but in essence, the equivalent amount of battery recycling capacity. And it's not just about recycling the key metals and making a business out of it. It's actually, there's a environmental responsibility element to it as well. And what you're seeing as a result of this big long-term opportunity in recycling, you're now seeing a kind of a boom time in that market. So we're just starting to see these recycling companies that are emerging, and it's a trend to watch. But as I said, it's just started.
Okay, final two communities to look at. One is, and we've covered this a little bit, but what's your advice for the commodity traders? And then finally, what's your advice for us as individuals, staring at this space, wondering, what the opportunity for retail investors are?
Yeah, commodity traders understand the chemical refining step. Understand, have a desire to understand not just what's coming out of the ground, but actually how much can get through this supply chain to actually feed lithium-ion batteries and EV growth. Understanding that bottleneck will be the make or break of the business, of your success within this market, for sure. The second and final question was investment. Okay, so we are independent data and pricing providers, so we don't give investment advice, we can't. But investors should look at this market in exactly the same way. You're balancing scale and speciality. I think we've hit this new accelerator step, this new step up. It started November, and it's going to last for probably about 3 years. What that means is there's going to be a boom time for the key battery raw materials for the next 3 years as money arrives, supply scales, and then, of course, eventually there'll be a period of oversupply and you're back kind of to where we were, but at a new high level. At the same time, of course, the EV boom is probably going to meet a commodity super cycle of sorts, a green-powered super cycle, whatever you want to call it. So the EV battery raw materials will receive a double boost, if you like, and that's something to consider as well.
Fantastic. Well, it's been a really fascinating discussion. I appreciate your your patience with us as we walk through it. It is a complicated supply chain. It is a challenging market, and it's one that is obviously going to be crucial to the future economy. And you just look at the numbers and number of presentations by you available on LinkedIn and YouTube, you and your colleagues, that are quite stark viewing in terms of some of the challenges that face lithium consumers and thereby the supply chain itself, over the next decade. But it's certainly, I think, going to be an exciting story. So Simon, thanks very much for joining us.
Thanks, Paul. I appreciate you having Team Benchmark on your podcast.
Fantastic. Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify. To find out more about HC Insider and Human Capital, a search firm dedicated to the commodities sector, go to www.hcinsider.global, where you'll find more original content on the commodities sector and more details on our offering as a search firm and our locations around the world. Thanks again for listening.